David, gosh, it's probably been a half a year or so since I've had a chance to talk to you. How are you, buddy?
Too long, Dale. How are you? It's good to see you.
Yeah, it's good to see you too. So, I mean, we have a new bull market running. Are you in that camp?
Yes, and I would say it's the challenge right now is what time frame you're talking about, right? I think the long-term time frame to me certainly seems constructive. In the short term, I'm seeing a lot of danger signs kind of in the classic pullback phase, suggesting we've had a really good run. We need to pull
Yeah.
back a little bit, reset, and arguably if you're bullish here, it's kind of counterintuitive, but the best thing you could see here is a pullback that gives a chance to reset and sort of take some of the euphoria off the table, which has been, I think one of the concerns in the first half of 2023 for sure.
So, some of those warning signals is it put call ratios? What are the things that
Yeah, so
besides?
I would actually just look at price momentum, right? And I'm looking at
Yeah,
Amazon here just as an example, one of the mega cap growth stocks. So
yeah.
one of the things that happens
Look at
at
that
the
divergence. Yeah,
Yeah, sort of it's classic exhaustion signals, right? We have this big
yeah.
run higher
There you go.
prices, lower momentum. I mean, it almost jumps off the page if you study it and look for these patterns. It kind of comes off. The problem is the chart of the S&P kind of having that same pattern as well. You're seeing it with some semiconductor names like let's see, LRCX is a good example of that. So,
AMD's been weak. There's been some weakness. Nvidia, I think that would may perhaps be the catalyst, Dave, if Nvidia started to come off and work into the gap, because that's really what got the party really flowing with buckets of champagne, right?
That's it's well put, right? And if you
Yeah,
think, I mean, just the strength of semiconductors in the first half of the year, really coming out of the October lows, was
yeah,
pretty impressive, and that became a group that I think the market sort of rallies around, pun intended, and continues to go higher. So the challenge with stocks like Amazon and Nvidia and others showing that exhaustion pattern, if they would roll over, even if every energy and materials and industrial name you name went higher
yeah.
significantly, if all those names roll over, the major indexes and the markets as we define them are going to struggle. And so with our growth oriented benchmarks, you really have to focus on growth. And I'm just seeing a lot of exhaustion signals here, going obviously in a pretty significant week with CPI and then the Fed coming up as well.
Well, I had real lousy timing in buying Apple puts, some from the 170-ish level and then some from the low 180s. And if you look at Apple, even though it's going to rally, you see that last gap up? Isn't
Yeah.
that you're talking exhaustion? So isn't that
Yeah.
an exhaustion gap? Because you do have other gaps underneath the market that could have been breakaway gaps or runaway gaps, but that looks like an exhaustion gap to me.
So, Dale, as always, you're eloquently speaking the language of technical analysis, and you're 100% right. So, after a big move, gaps can happen at different phases, right? You have, a breakaway gap, which is kind of early on the move, right? Sort of a
Yeah,
basing pattern,
down
big
there
gap
in
that
May.
reinitiates it. This
Down
is
there
more of
in
an
May looks
exhaustion
like it.
gap.
Yeah, see the May gap up. That was earnings, I believe.
Yeah.
Yeah,
So kind of a
yeah,
basing pattern, kind of a sideways pattern. All of a sudden, something changes, something's different. When you
yeah,
have an established trend like this and you have that gap higher, it's like that last gasp, right? It's that last big jump. And then it's sort of like the music stops and everyone looks around and says, okay, hold on, where are we? And then we start to see profit taking. And again, I'm seeing these sorts of signals on too many names to not expect a decent pullback here. But
okay,
again, what you have to remember is on any of the charts that we've just shown on Apple, on Amazon, on Nvidia, on any of the others, there's a lot of room to pull back and still be within a pretty reasonable uptrend. And I think
right,
that's the reality of what you can expect here July into August.
okay. Great. Do you have a handle on interest rates, Dave? I mean, they've been all over the map. 10-year took out the 4% handle, and
I don't know if
bonds
anyone
look like
has a
they're under
handle on interest
pressure.
rates at the moment, Dale, but I hear you.
Yeah, even the Fed, right? So
Yeah, right. We're all trying to make sense of this.
they say
But
Powell's exasperated by how much he's tightened, and really not seeing the effects in certain things. But
so, I mean, when you think again, there's this sense that the Fed, I think, tries to portray, which is this omnipresent, omnipotent. All we need to do is pull these levers and everything's going to be fine. And they work really hard to convey that message. I think in reality, if we really study what the Fed is trying to do in, raising rates and slowing the economy, it is, I mean, you are really like trying to steer the Titanic with a rudder and just barely trying to move this big machine with a huge lag between what you do. It's like a really sluggish airplane control, and you're trying to move it. There's such this lag between what you're doing. So rates have been pushing higher, right? And I was listening just at the end with you and Blake and others just talking about the conditions here. You've seen bond prices pop lower here, and I think for me, I'm looking at this, sort of on that medium term time frame. Rates really were consolidating for quite some time, really about 9 months. When you look at the October high around 4.25, from there it's been sort of this consolidation kind of basing pattern, and then just in the last week you've seen a pretty significant change, breaking above around 385, now pushing above 4%. I think the reality is what the Fed is trying to do here is change the conditions.
Okay, and do you think they're going to go? I know you're a CMT and not an economist, but do you think they're going to go?
From a technical perspective, this is a new uptrend in bond rates, right? This is the new uptrend in interest rates.
What would you call that formation? Because I kind of had like a flat bottom, and it looked like a descending triangle, but I guess it was just a pennant.
It depends. You could arguably call this a flag pattern, which would be sort of this big downtrend and then kind of a parallel decline there as well. And again, whatever you label it, this resistance at the top is pretty important. So the fact that we've broken that, to me, in technical analysis and investing, is all about determining what the trend is and then figuring out what you would need to see to change. And I think at this point, bonds are going down. And if you look at what's happened over time, this sort of environment with rising rates is really not great for growth stocks. It's really more inclined to value stocks. So when I'm seeing new 52-week highs in the industrial sector, you're seeing energy stocks start to get a bid, oil services bouncing off of the lows. That's kind of playing into this growth, take a break narrative and rising rates. And again, I think that could be more of a short-term phenomenon than long term. But I think if you've been riding the growth trade through 2023, this would be a really good time to sort of unwind a bit of that and watch a pullback play out.
So, I mean, this would portend new highs, a formation and a breakout and even a breakaway gap that we have here.
It suggests much further upside for the 10-year yield. And again, I mean, on a chart like this, I'm looking immediately to the left and seeing 4.25 as a pretty decent resistance. You see the dollar sort of heading back towards support, as Blake's chart, I think, was showing earlier. That's all true. But I think, again, just because we've hit those levels doesn't mean those levels can't be broken for sure.
Yes. Okay. So the market's been able to handle and, not. Okay. So the market has been able to handle it. So you think we'll see rotation out of the big tech and into value trades, value shares, right?
Very much. And if you're looking for charts that are compelling, right? I mean, I'm looking at something like the industrial sector, right? Making a new 52-week high. And this is as growth stocks have made a run. And we compare that to the chart of like an Amazon, and you can see the difference here, right? This is sort of an extended rally, and then the divergence really playing out, sort of showing the end of, are basically expecting the end of the move and showing a trend that's going higher, but on much weaker momentum versus industrials, which is actually thrusting higher on stronger momentum. It's actually been sort of anemic for quite some time. So this is that breakaway gap we talked about. And you're seeing that on names like that. So, I mean, it's stocks like building materials and, home builders are kind of tangentially related to this, airlines, right? Sort of pushing higher. So it's a lot of these areas of the market that have not been sort of the juicy parts in the first half of the year. I think in the third quarter is where you start to see some real opportunities. And again, what's going to be funny is, or not funny, but what the reality is, the S&P, the NASDAQ could retrace quite a bit, while something like industrials and energy are actually flourishing. And if you go back to the first half of 2022, you see exactly how that plays out, where benchmarks are driven by growth, not by value.
Okay. I wanted to ask you about the view that you have possibly in the dollar. So, what it's projecting for you. To me, it looks like, we broke down last week, and you would think this would be pretty good, a benefit for stocks. Weaker dollar usually is risk on for some stocks anyway.
So I think, and again, I don't know whose chart I was seeing right when I was logging on here, but I was trying to just catch up with what you're saying. I think this level right here is pretty significant. And and to me, that's the level that I'm watching. And as long as we hold that, I think you're, pretty confident in what we call a basing pattern. A basing pattern is basically, it's not a directional move. It's not a clear uptrend or a clear downtrend, which we saw previously. It's more of a consolidation. This is really a market in equilibrium. This is the market saying the dollar is about 103, and we're just kind of overshooting and undershooting that level. And what you look for is when we break out of the basing pattern, right? At some point, we don't do this forever. At some point, we sort of resolve this pattern to the upside. We get above the 200-day, maybe above 105, or we break down and we make new lows. And I think that break in the dollar is going to be very, very telling. For me, I see this as a key support level. Wouldn't be surprised if we pull back to around here. And then as a pullback starts to happen, I wouldn't be surprised if we actually get a stronger dollar there and get a little more defensive in the near term. But we'll have to see. I think that level of support is significant.
Clean out all the dollar bulls first before there's a turn in the dollar.
Yeah, right. And you see the same on the chart of gold, right? You guys are talking about that as well.
The gold shares, they look like they're turning for at least a trade to the upside. Gold and
and one level I would point out to you, I think what you have to think about is the symmetry in gold over the last year and a half or so. So if you take the November low, which is around 1620, take the high in May, which is around 2085. 38.2% of the way down is 1906, which is literally right around where we've been over the last week and a half or so. So a bounce here actually makes sense more on that longer term level as well, which is in perfect symmetry to what we saw on the way down, kind of very similar levels. And so I think a tactical bounce here at least makes a ton of sense. So I think betting on that a bounce in gold is pretty good here. Gold, I mean, it's funny. A month and a half ago, gold was one of the better charts you could find in terms of this nice uptrend breaking out. It's really pulled back in a meaningful way. And the chart of gold may be a preview of what we see on some of the growthy stocks that have had a pretty good run as well. So I think that's a good actionable rally point right here.
I actually think it's bullish that it only pulled back 38% instead of halfway back, and it was and it was more of a time correction than price correction.
It's a really good point. And what you have to remember, right, there's two ways you can correct: price, meaning a big pullback; time, meaning it's just the market has to take time to digest things, or both. And I think here you've had sort of this slow kind of steady pullback, which has been more of a wait and see sort of period, but now pulled back just enough that it's reasonable to go higher here. I think you're right. I think for me, Fibonacci retracements, I mean, are just a good framework. It's a good way of looking at what's happened and just thinking about where we're at relative to where we've been. The fact that gold's only pulled back this much tells you it's not an end of the world move we've been in. It's more of a pullback within a larger pattern that we've been following.
Okay, and let's get to what made headlines while you and I were not in touch, and talk about the regionals. And they've been holding, but is there anything to convince you like KRE has bottomed? To me, it looks like it needs to break one more time.
Yeah, so the financial sector, again, a lot of these stocks have had really good rallies, but they're rallies off of such beaten down levels. And so that's a tough one to play, because it's not like a basing pattern, which is more of a sideways pattern, and then we break out. This is more of a beaten down sector, and it's just trying to find a footing. I would agree with you on KRE 44 is the level. I have an alert set for the KRE above 44. And I tend to go with what I call the line in the sand approach, right? As
Okay.
long as the KRE remains below 44, whatever rally we have is still sort of a bottoming pattern. You could see this as a big inverted head and shoulders bottom. I think that might play out, but you have to get above 44 to validate that pattern. And so I have an alert set for 44. I'll worry about it when it hits that. I think when it hits that, that tells you that there's been a recovery. And I would say with some areas, I mean, if you look at something like JP Morgan, there are stocks that are starting to look a little more constructive that actually have had basing patterns and are starting to resolve out of there, but they're kind of the outliers. It's not the average stock. The average one's still
Wells Fargo
Wells
Fargo looked okay until last week, but I mean, it could just be another failing rally.
That's another side. It's not just about whether these stocks get a signal. It's also about the follow through, right? And I think one of the telling technical takeaways you can draw is when something seems like a real obvious win and then it fizzles out. That tells you that there's just not a lot of momentum behind that move. That's the concern on a chart like Wells Fargo for sure.
All right. Well, speaking about a lack of momentum, wouldn't you consider Goldman Sachs one of the best of breeds for a long time when it comes to this sector? And
certainly, right? Yeah. I mean, when you look at leadership areas, that's the one that would come to mind. From a technical perspective, it's really been a choppy. One of my analysts used to say it doesn't chart well, and I think that's a good way to describe Goldman Sachs. I mean, it's just it's been more of a mean reversion experience. It's not really. I mean, at a time when you have certain areas of the market, industrials, airlines breaking out, gambling stocks working, you have things clearly breaking down, like energy at times. Then you have a Goldman Sachs, which is more of a choppy sort of sideways experience. And I think this chart is more about mean reversion than anything. It's more of, I mean, really Goldman has been at around the same level since, the beginning of 2022. And it's been just sort of chopping around that sort of level. So I'm encouraged by the fact that we're at the lower end of the range here that we've been for the last 3 or 4 months. But in my opinion, is that the best lever to try and pull in this environment? Probably not. I would say break down.
I mean, we're not that far from the March low.
That's what I'm saying, right? We're sort of at the lower end of this range, and that is very much a check in the
with a strong market.
Very, very true. Very, very true.
I mean, if you're a believer in relative strength, readings and how they behave. Goldman has made no hay out of this huge rally we've had this year.
No, that's totally fair. And here's the relative strength line. You can see how weak it's been on a relative basis. I mean, it's been the financial sector in general has been sort of a forgotten area of the market at a time when, if you look at what the conditions and how they've evolved, you would think financials are probably doing a little bit better, just given a rising rate environment, given what could be the scenario in the coming months. But not yet.
I think that they all look kind of vulnerable to me. So, and I'm not sure what they would prefer, higher or lower yields, but the charts say higher, right, David? So,
but you think that would help? Is what the charts say. Something else.
Anything else that you'd like to cover that's top of mind, or the way you're looking at the summer? Someone's asking you what you think. Carol wants to know what you think about the NASDAQ rebalancing coming up. What are they going to do? What the Dow did and kick out the weak sisters and bring in new leaders?
Yeah, so it's funny with I mean, it's not funny, but with indexes like that, there's always a rebalance of sort. Not always, but you have to remember that when you think of something like the NASDAQ 100, you think of it as a static group of stocks. And the reality is all of those indexes fluctuate. And if you look at the S&P, the Dow, the NASDAQ as well, I mean, all of these indexes, they're fluid in terms of the members. So when you're looking at a longer term trend, you're looking at less and less of the same groups of stocks that are playing out over time. The NASDAQ rebalance is really going to try to address the overweight in the mega cap stocks, right?
How are they going to do that?
So what they can do is just kind of change the weighting. I think they're talking about just redistributing the weighting. So taking, redesigning it so it's less of an overweight in the mega cap names and redistributing that to some of the smaller stocks within the index. So sort of recalibrating it. And this is the fact that they have to do this tells you probably all you need to know about the challenges of this market and the narrow leadership, right? If you take the Microsoft, Apple, Nvidia, Amazon, Meta, Alphabet out of the picture, the equity market in 2023 has not been particularly strong. It's actually been quite mixed. And so what they're going to try to do is alleviate that. I think that's more of a sign of the times of this overweight. And I would say that
it's kind of like trying to stack the debt because they're worried about the hand they're holding.
It reminds me a lot of stocks becoming very overvalued. So instead of thinking of that as a bad thing, we talk about different ways to value companies because obviously just the tool is broken. And usually that's at the end of the move when people start having that kind of conversation. So I would say that this is probably a little too late. And I think it suggests, I think it plays into the narrative we've talked about before with, when you have to rebalance the index because the biggest names have over dominated them, it tells you how extended they are. And I think a pullback would automatically reset that index probably in a pretty meaningful way. But yeah, that's happening pretty soon here.
You think 115 Apple would do that?
Well, right. I mean, so there's two ways that this fixes, right? Is that the market corrects itself and refixes it. 115 is quite a way below where we're at, though. I don't know if I would do that unless we're talking about a split of some sort. I doubt it.
Or a crash.
There's something, right?
I mean, no one thinks there could. Everyone's saying if there's going to be any kind of, real dramatic market sell-off, that's going to happen in October, like it always does.
Well, so I mean, what's funny about 2023 is that it's playing out really in some classic ways. It's actually been stronger than you would expect, right? Months like June are actually pretty weak, and we sort of went right through there. But with most years, and definitely in a pre-election year, that sort of rotation lower into the fall has played out so consistently, and we seem to be setting up perfectly for that same scenario that we always kind of and I think that's a pretty decent way of playing it. But what I would say, Dale, is what I always talk to people about doing a probabilistic analysis, which means as traders, we always think about a position, right? I'm short Apple, so here's what's going to happen. And then you sort of think through that. So you're sort of visualizing that scenario. What you have to remember is Apple could go down 5%. It could go down 15%. It could go up 5%. It could go up 15%. And thinking about each of those scenarios, what would that look like? What would that do to your portfolio? When would you take profits? When would you unwind something? When would you add to a position? Thinking of things in those terms, I think, is really helpful. So especially now where the market feels vulnerable, thinking of some different outcomes, what that might do to your current portfolio, when would you need to change positioning? How would you manage risk? That might just help you to anticipate and just deal with whatever unusual outcome sort of plays out here. Because I think there are a lot of paths we could take, and I think most of them, in my mind, most of them point to some weakness going into September, October. I think that's a pretty reasonable expectation given the run we've had so far.
Well, hopefully Tim Cook has moved enough of his manufacturing to India. In case China, which that relationship keeps getting more and more contentious. Yellen visits, any visit from U.S. diplomat, we visit them as we're taking away, and now we're national security's higher than economics. So anyway, I think China, anyone who relies on China right now, I think they're vulnerable. So Apple does rely on China.
Yep, and a lot. I mean, with big tech, there are a lot of companies with vulnerability there for sure.
Yeah, I mean, if we're adversaries, they have the potential to do some damage. Just something I'm thinking about instead of an invasion of Taiwan, because it's still a Cold War. So David, what great looks again today, and the reasoning you give the hows and the whys of what you're looking at, when you're going through a market recap. And so people not only get your ideas of what can happen, but the why behind it, so that they're learning, and that they won't always have to, see what David is saying to know what they learned from David. So you're a natural mentor, and it was great getting back together with you, Dave.
It's good to see you, Dale. Thanks for inviting me on today. Appreciate it.
Yeah. So, everyone follow, at the minimum, follow Dave on Twitter at DKellerCMT, and go to his shows. He has great guests. He does a review that is as good as any of the guests that he does on stockchart.com. It's The Final Bar. And I don't know, the way things are, that's where I'd like to spend my last days, at The Final Bar.
Hopefully not anytime soon, Dale, but thanks again. I appreciate it.
All right, David. Great talking with you. Dave Keller, everybody. Follow him. He just showed you live what you can learn from him. Adios, David.
Take care, Dale. Thanks.
All right. And you could join the team in 16 minutes on the Morning Edge. Good luck today. Don't just count your pips, count your blessings. We'll see everyone tomorrow. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.